Good morning, everyone. I, Aryan Doshi, CFA, an equity research analyst from Divisha Investments. Welcome to the Divisha Investor Interaction Series. Divisha is a SEBI-registered research firm founded by the investors for the investors. And today we are decoding Park Medi World. Before starting, one disclaimer: this is not an investment advice. We may hold positions in the stock. But before I jump in, there's a quick question for everyone. India being the most populous country on the planet, how many hospital beds do you think we have per 10,000 people? Just 15. And the global average is 29. We are literally at half. And here's the thing: India's median age is just 29 years, and this is the youngest large economy in the world. As this population ages, as income goes up, health insurance spreads, demand for hospital beds is only going one way. And the question is, who is building those beds? We see in the tier 2 and tier 3 North India where the gap is the widest. And that's the Park Medi world.
Hello.
And that's
Hi, good
why
morning.
we are here today. And to help unpack this story, we are delighted to have Dr. Sanjay Sharma, CEO, and Mr. Sudesh Sharma, CSO and OSB Finance, and Mr. Saurabh Pant with us. Sir, it's a pleasure to have you with us.
Are we having this echo?
Hello. Yeah. So today's agenda is very simple. We'll go through the slides one by one, hear from the management, and then open it for a Q&A session. Let's get started. First we go to a company overview slide. Agrim, you can switch the slide. Yeah. So we can see the Park Medi World, established 2005, headquartered in New Delhi. They run a 14 multi-super specialty hospitals under the Park brand with over 30 specialties. Now, if you look at the numbers on the slide, 9 months FY26 revenue clocked in at 1,219 crores with an EBITDA of 317 crores at 26% margins. The PAT of 197 crores, that's 40% year-on-year growth, and that's strong. We can see the average revenue per occupied bed, the RPOB, has moved from 25,000 to 27,000. And the current capacity beds, 3,600 beds, and the target is 5,400 beds by 2028. Now, here's something really important to understand about the business. 83% of the bills come from government scheme reimbursements. And out of that, 93% is central government. That's a very different risk profile compared to a typical private hospital. Promoters hold nearly 83%, and this is the second largest private hospital chain in North India and the largest in Haryana. With that foundation, let's understand the industry tailwind. We can go to the industry outlook. So here we can see three things to take away from this slide. The Indian hospital market was about 137 billion in 2024, and it's projected to reach 265 billion by 2033. That's roughly a 7.6% CAGR. Second, as I already mentioned this upfront, only 15 beds per 10,000 versus the global average of 29. Any company that adds beds efficiently is going to see a sustained demand. It's as simple as that. And third, and this is where the park fits beautifully, their affordable care strategy targets the lower middle and middle class segment. They're not fighting Apollo and Max for the premium patient. They're capturing the massive volume coming through government schemes, which will be Ayushman Bharat, central government health scheme, and others. And they're not standing still. They're moving into quaternary care, dedicated cancer units, kidney transplant approvals in 5 hospitals, and 3 Da Vinci robots for robotic surgery. Now, if we see the company insights, we can go to the next slide. You can see 4 pillars on the slide. Let me just highlight what matters. The capacity, if we see, there are 5,400 beds by 2028 and 700 crores capex at just 35 lakh per bed, where the metro cities have 1 crore per bed cost. If we see the cluster strategy, this is their edge. No hospitals in the same region, sharing of doctors, referrals, brands, protocols. So acquired hospitals already contribute 55% of the revenue and 58% of the PAT, and they break even at just 30% occupancy. If you see the third point, the UP entry, this is their big bet. The 26 crores of population and bed density way below the national standards. 3 pivots here, the Agra facility, Kanpur and Gorakhpur facility. 0 to 1,000 beds in just 24 months. And the balance sheet, if you see, the 425 crore pre-IPO debt down to just 15 crores now. So it's nearly debt-free now. And if we see the leadership behind this, we can go to the next slide. Dr. Ajit Gupta, chairman, 44 years in healthcare, built the Park brand from scratch. And Dr. Ankit Gupta, MD, heads operations, 20 plus years. And today we have with us Dr. Sanjay Sharma, CEO, and Mr. Sudesh Sharma, 15 plus years in finance, former group CFO at multiple listed companies. We see a deep clinical expertise here combined with strong financial discipline. And in a capital intensive business, that's exactly what you want to see. Now, if we see the most important slide of the deck, it's the acquisition slide. We can go to the next slide. So the table tells you the whole growth story. You can read each line, but let me call out one that really matters. As we see the UP one, the Agra 360 beds acquired for 245 crores. It's NABH accredited and target is 100 crore revenue with 80 to 20% EBITDA margins. Also, we see Kanpur with 300 beds. It's a brownfield acquisition, gives them the whole central UP zone as operational by April 2026. So you see the Gorakhpur 400 beds, 30-year operation agreement. We see the eastern UP covered here and which massively underserved. The Narela, Delhi one, picked up through NCLT and 109 beds already live. The Bhatinda one with the 250 beds for just 40 crores. So the Punjab expansion is also done. Then you have Panchkula, Rohtak, Mohali, and Ambala all on the table, all phased out between FY26 and FY28. And you can see the details. Now step back and see the pattern. Acquisition, greenfields, brownfields, NCLT deals, O&M agreements, and the blended cost, 35 lakh per bed. In a metro, one bed costs you over 1 crore. That is good capital efficiency. And this is not a hospital adding one unit, this is a platform scaling. Now, if we see the valuation slide, again, we can go to the next slide. We can see the peer comparison here. Park trades at an attractive valuation of 41 times PE compared to the peers. And the EBITDA margins at 26% and the ROC at 22% and ROE at 20%. It trades at a very attractive valuation compared to the peers. And if we keep the picture balanced, we see the risks. Again, we can go to the risk slide. Yeah. So if we keep the picture balanced, the first risk will be occupancy ramp up. New hospitals take time, but 30% break even and cluster referrals mitigate this. Second will be revenue concentration. 69% Haryana and 83% government, and out of the 93% central government, they're diversifying. But to mitigate this, they're diversifying into UP, Punjab, and Rajasthan. Third will be the execution risk. A lot of projects at once, phased commissioning is the answer. And you can see the working capital risk also, where the receivable cycle is at 4.5 months, but it is expected to come down to 3.5 as private mix improves. And if we see the summary, let me bring all it together. Strong 9-month FY26 with occupancy moving from 62% to 65%, patient footfall up 24% to 6.6 lakhs. As you also already discussed, 5,000 beds by FY28 at 700 crores capex, and the UP strategy, 3 pivots, 0 to 1,000 beds in 24 months, and the long-term vision is 10,000 beds. Nearly debt-free after IPO, and the CGHS central government health scheme rate hike from FY27, and the receivable cycle is also improving. And the standout, gross block per bed at just 35 lakh. Rapid break-even, high asset turnover. This is an affordable healthcare platform scaling into India's biggest capacity gap. With that, I would love to invite the Park team, Mr. Sudesh sir, Sanjay sir, and Saurabh sir, to share a few words about where they see Park Medi in the future. And after that, we'll open the floor for a Q&A. Now, over to you, sir.
Yeah, hi, Arun. Can you hear us?
Yes.
Hi, everyone. I'm Saurabh Pant. I have recently joined as the head of IR for Park Group of Hospitals. I'm currently joined by Sudesh Sharma. I think he will be joining us in the next minute or so. He is the Chief Strategy Officer and he's here. Chief Strategy Officer and OSD Finance for Park Group of Hospitals. Unfortunately, Dr. Sanjay Sharma, who is the CEO, is unable to join us today. But yeah, over to Sudesh.
Hello, thanks for everyone's participation. I'm looking forward to a constructive, interactive, informative discussion with all of you today. Uh, Aryan has very nicely summarized important points concerning our current context in terms of numbers, where we are. How would you suggest, Aryan? Should we get straight to Q&As, make best of the time we have at our disposal?
Yeah, so we can directly go to the Q&A. After if we can have a few words on the future.
Because I believe after this snapshot summary you have given,
Yeah,
which sets the right backdrop, I would hate it if inquisitive questions, because of time constraint, remain unanswered.
perfect,
So
perfect.
let's, I think, come to Q&A straight away.
Yes, yes, yes. I will allow the mic of Mr. Charanjit Singh. He wants to ask some question. Mr. Charanjit, I have allowed your mic.
So you
Also,
need to unmute yourselves.
yeah, you can unmute yourself, Mr. Charanjit Singh. I think he's not responding. We can go to the second question. Mr. Varenya Agarwal, I've allowed your mic.
Yeah, hi. Thank you so much for the opportunity. So I had two questions. One is, can you just explain how our cost of per bed is around 35 lakhs when we mentioned that for the peers it's somewhere around 1 crores? Second, if we look at the historical numbers for the hospital, the growth has not been what we just quoted, say somewhere around 40% right now. So historically, I think it was somewhere around 10-15%, if I'm not wrong. So just to clarify, I mean, why has this growth come? Is it a inorganic growth? That is why, or generally, what is happening in terms of the growth of the hospital?
All right. Thank you for your question. One by one, starting with operational capex. Uh, something I should have stated earlier, and you will find what you will notice is that in all through our interaction, there will be three themes we will continuously keep emphasizing, which collectively comprise our proven business model. These three themes are one, that we are in the business of providing relatively affordable healthcare. Second, that we provide world-class, high-quality healthcare. Third, that we over the years have developed a business model that works on a very high level of end-to-end operational efficiency and delivers a very strong profitability that matters to investors. So profitability is theme number one. Theme number three. So relatively affordable healthcare, which is high quality and is delivered profitably. Other three themes we will keep emphasizing in all our interaction. So one of the elements that makes our business model efficient is also how we approach capex. Our per bed capex, per operational bed capex is currently at 34 lakh. I am especially very pleased to tell you that this 34 lakh per bed capex will continue to hold till the time we have successfully executed and commissioned our expansion plan over the next 2 years' time. So till the time we reach 5460 bed capacity by FY28, the same 34 lakh per operational bed capex will apply. Now the question is, how do
So,
we
can you
arrive at this
explain
capex?
how is it so low? I mean, the question was compared to peers when they're saying almost three times the capex per bed. How is it that Park is able to do it in such a lower cost?
Yes, yes, I am just coming to that. Let's just divide our operational bed portfolio into two buckets. One is organic developments, second is acquired assets. Let's also include a unit that we are very shortly going to commission in Panchkula in the mix. So 16 assets, if we look at accounting for 3960 bed capacity, of this, six are greenfield and 10 are acquired assets. So I'll talk about per bed capex for these two categories one by one. So you get a comprehensive understanding how we are able to arrive at this capex. Talking about acquisitions first. 10 acquisitions we have done so far. When we acquire an asset, in every single instance of our acquisition, this asset would typically be grossly underperforming its potential. We would normally like this asset to be, should we want to pursue it for acquisition, we would want this to be very uniquely located in terms of easy access to highway, and also in terms of location in a high potential micro market. We of course analyze a heap of parameters as we assess our acquisition, but these three things play an important role, and we also do a deep analysis of what value we can realize from this asset post acquisition, maybe after deploying some capital of our own. But the key point here is when we acquire these assets, these are underperforming. So underperforming assets typically tend to be underperforming because of following reasons. Either the management is incompetent, or the asset is not able to meet requirements of the micro market, or it is over leveraged. In most instances, all these three, combination of all these three factors leads the asset to be significantly underperforming. Now, this asset which is underperforming would typically be of size that matches Park's sensibility, 250 beds, 25 beds here and there, located in a good location on a land area of maybe 1 to 2.5 acres. So when you look at this asset, to begin with, this is an asset that is carries a little sensibility matching with the hospitals that Park runs. One second thing is that when we approach acquisition of this asset, we find that following things go in our favor. One is that this asset is, as I said, underperforming. So the normal ways of valuation are not applicable to this asset. We cannot apply DCF techniques. We cannot use capital asset pricing model. We cannot use EV/EBITDA multiples because technically there is insignificant EBITDA. So what we do is we take a stock of assets, land, building, equipment, and we assess what value we can recover in a certain time frame going forward. Now this asset is also simultaneously over leveraged. So the seller typically is not in a position to have a very prolonged discussion on a sell transaction with an interested party that might want to acquire this asset. So there is no time on hand typically for due diligence that would last 6 months time, acquirer raising bank loan, or a payment plan that will entail partial payment in the first year, maybe revenue performance linked payment in the second year. What they want is out immediately, soonest possible. So Park has always been known to be a very strong finance in terms of financial strength. We also keep ready reserves with us, which enables us to execute the transaction at lightning speed. When we acquired our Mohali asset in May 2023, this is a 225 bed asset. I would like to highlight when we acquired this asset, this was doing a revenue of 40-50 lakh a month. In 32 months time since then, the revenue has increased to 38x. So we assessed this accurately. And I can tell you that when we acquired this asset, this was coveted by all the players. Everyone wanted this. And I think key differentiator was that we could execute this transaction at very faster speed. In and out, we completed this transaction in 45 days time. I would also like to give another example. When we acquired our Palam Vihar unit, it is even today the most important hospital of Palam Vihar. We acquired this in January 2021 from Metro Group, which is by itself a large chain. At that time, this asset was also doing monthly revenue of 45 lakh. In 6 years since then, revenue has increased by 44 times. February revenue is 22 CR on a monthly basis, and February was a brief month, 28 days only. When we acquired this asset, for 107.5 CR, of which valuation of land building itself was about 70 CR. And this asset used to have a loan of 82 CR. Just revenue of 45 CR, loan of 82 CR. If one does 2 plus 2 math, it is evident that the asset was not in a position to service the interest on the loan it had on the books. So forget about repaying principal when it was going to come up for repayment, nor was it going to be left with any surplus cash to meet salary requirements, operational cash requirements of running the hospital. So we acquired this for 107.5 CR. And today, if we look at the fact that in FY26, this will be in all likelihood giving we close with revenue of 260 CR with the 26-27% EBITDA. It's very simple to arrive at a conclusion that even if one uses let us say, a ridiculously low EV/EBITDA multiple of 12 or thereabout, the valuation today should be in excess of 1,000 crore, which is 10x increase in valuation in 6 years' time. So when we look at the first bucket, acquired assets on a composite basis, sigma basis, the total sales consideration we have paid for acquiring these assets, 10 assets, has been about 720, 730 CR. In addition to this, on top of this, we spent some more amount in upgradation of infrastructure post-acquisition as well as for provisioning additional equipment. So total acquisition cost, including all these pieces, for all the assets 10 acquisitions stood at about 920, 930 CR. When we look at FY26 numbers, the acquired assets' contribution to revenue is about 62-63%. We are hoping that we will close this financial year with the revenue of about 1675 to 1690 CR. So if we take 62% of this, that lands us at a figure of about 1050 CR, which on a ballpark basis tells us that we judged these assets accurately. In revenue terms, we recovered our investment within 11 to 12 months time. So these assets were a good selection. These were value accretive. And as I said, for this portfolio of acquired assets across 10 assets totaling about 2,400 operational beds, the total cost was about 920 CR, including the cost of infrastructure upgradation and equipment provisioning. We recently acquired a hospital in Agra. Once again, we were keen to enter the city of Agra because of very strong dynamics that we liked. And we zeroed upon an asset which was unfortunately significantly overpriced, which one of our competitors developed a keen interest in, although this transaction eventually could not close, but we let it pass. And very soon, we were able to identify another asset on the 19th of December. And we immediately notified to the stock exchanges that we had intention to acquire this, as well as commission this before end of February. And that's exactly what happened. This asset in Agra, 360 beds, which we acquired at a consideration of 245, the most strategically located asset in the city of Agra, but we closed this transaction and commissioned this on the 15th of February. So this gives us a very, very strong competitive advantage in pursuing acquisitions. Now talking about the first bucket, greenfield developments. In greenfield developments, what happens is that obviously this entails different pieces coming together. There is a land piece, you have to construct the asset, you have to furnish it, you have to provision equipment, etc. So when we look at a land, first of all, the land is typically the source of land is either a third party who acquired land from government at some point of time or government itself. Our Patiala asset was directly secured from government agency in a fairly competitive bidding. So what happens when we bid for these land plots is the following. In other situations, land could be a part of a township development license for which might have been given to some prominent developer. Township license typically are given to proven developers because it requires a lot of expertise to complete a township. So townships typically have a small area set aside for institutional development, namely hospital development, which developers would like to sell to a reputed hospital company, simply because that is how it increases the stature of the township itself. These plots would typically tend to be about 1.25 to about 2.5, 3 acres. And to develop a meaningful infrastructure in an NABH compliant way in this asset might not be possible for 2-3 large hospital chains. At the same time, whether it is government auctioning this land or the private developer, they will not be interested in a less staged hospital chain because that defeats the purpose of why they would want to sell. The real idea of selling it is to ensure that it adds to the profile of the township and really provides high quality healthcare services to the inhabitants or people in the micro market. So we have competitive advantage in these situations. We get land. Smaller players will not qualify on technical criteria. will not get preference from the auctioning agency, and the very, very large players might find it hard. For example, we have a hospital in Karnal, which was a part of one developer township. The developer was a CHD, and we bought it from someone who had bought it from CHD and developed the hotel for us. But in that location, it is hard to imagine that a Fortis or a Max would have been able to do a hospital of our size. We have a hospital which we commissioned, or let me just, I think this answer is important, question is important. So spending a little more time on this, I will request your patience. So this is,
Of course,
in
sir,
fact,
if I can just add one more point to this while you are answering, you said that we are good at acquiring. So just if you can add, how is it that others are not able to do something similar? Why is it that Park is able to get such good deals?
Yeah, this answer will flow from my explanation. So I was telling you that let's run through a quick basis history of our growth in terms of addition of assets, both organic as well as inorganic. In 2012, we commissioned our facility 275 beds in Gurgaon sector 47. The land was bought from Unitech. It was a part of their township. Our total capex for commissioning this facility was 58 crore only at that time, translating to 275 beds. The facility delivers 22 CR monthly revenue today. Fast forward 4 years. In 2016, we commissioned organic development in Panipat, 175 bed facility, which we commissioned in and out total cost sigma basis for 28 CR, translating to 175 beds. Fast forward 4 years again, in 2020, we acquired a unit in Ambala, 250 beds, for a consideration of 65 CR. We spent additional 20 CRs on this for infrastructure upgradation, but again, 85 CR translating to 250 beds, so roughly the same number. Fast forward 4 or 5 years again, we acquired in 2025 Bhatinda unit, 250 beds. Total acquisition cost was 40 CR. We spent 20 CRs on top of that. So 60 CR translating to 250 bed capacity, about 24 lakh. The asset that we are next commissioning in Panchkula is a 350 bed capacity. Our total cost land was purchased from government for 40 CR. The total rest of the capex has been 75 CR. So 115 CR translating to 350 bed capacity. We will also be this calendar year commissioning a facility that in Delhi, North Delhi, that we purchased under IBC provisions through NCLT route. This is a 200 bed facility that we purchased for 51.6 CR. We will be spending 20 CR more on this for equipment and some slight infrastructure upgradation. So 70 CR translating to 200 beds. I have to also say that this facility, on account of unutilized FAR, will allow us to add 70-80 beds more on top of 200. Again, the formula remains the same. So what I'm trying to say is that this 34 lakh number is held on from 2012 till now, as well as going forward, which is why I said that till FY28, when our operational bed capacity commission working on ground becomes 5460, this 34 lakh number will continue to apply for that. You had a question, I think it has just dropped out of my mind. If you can repeat that. Growth.
So we can keep it brief only because there are a lot of questions right now.
Just about the growth, sir. It's okay. We can move on.
No, before that, I think you also had a question related to acquisition itself. Yeah, why other people are not able to acquire. You see, take example, Devashish, of our hospital in sector 47. This is in close proximity. If you draw a 4-kilometer radius circle, Max is located in the circle, Fortis is, Medanta is, Artemis is. But to my mind, I think our hospital does an occupancy of 85%, which is the highest there. Now, what happens is, look at this hospital's dynamics. We are running 275 bed facility there, and our ARPOB is 29,000 thereabout. It is, our feeling that if one of these chains that we just talked about was running this hospital, maybe the number of beds they would have been able to run would not have been more than 90-100, because some will be executive suites, some presidential suites, some larger area rooms, lobby area would be large parking area, maybe there would be Starbucks, Pizza Hut, etc. Let us say that this hospital chain was able to acquire an ARPOB of 75,000. But just see the math. We are able to financially perform better because our performance basically looks like this: 29,000 ARPOB over 275 beds, and 100% claim on the revenues we earn. There is no sharing. All the assets are owned by us. Whereas this other hospital chain maybe would have realized an ARPOB of 75,000 over 90 to 100 beds. With maybe 93, 94% share of revenues. Most hospital chains have 93 to 94% share in the revenues that they earn on a group level consolidated basis. So will someone want to do a 75,000 ARPOB business model with a 90 bed capacity? I think maybe not. But it makes a sense to us because it is prominent location, fantastic location where today there is no land available, not even for worth of gold. And we can make sense of this by doing 275 beds, all NABH compliant, sticking to our business ethos of high quality, relatively affordable healthcare delivered profitably. How profitably? 275 into 29,000 into 100%. So for us, this makes a sense. So when we are going to bid, it will be competitive advantage because this other party might not find it in sync with the business model they might want to superimpose over this plot. So that's all. I hope this answers to
Yes, sir. Thank you.
Yeah, before moving to the next question, we can keep the answer brief only because there are a lot of questions. Hi, respectfully. Yeah, I would allow Mr. Debashi sir. I have allowed your mic. You can unmute and ask the question. Thank you.
Am I audible?
Yes, yes.
Oh, yes, very audible. Thank you. Please go ahead.
Yeah,
You are
sir,
audible, but we are not able to see you, Devashish. Is there some issue in the camera?
no, I'm connected through an extended laptop, so that's why.
Okay, sure. Okay,
Yeah.
no problem.
First of all, congratulations, sir. What you're doing is worth. It's reflected in the numbers. What you're doing is great. Sir, I have two questions. First is if I break the business between organic, the core business, and the acquired assets, okay, which you're integrating to the core. In the core business, I have two questions. One is what a patient would say. I'm not saying investor. What a patient would say going through the services, what they take in your core business, what they would say apart from affordability. That is number one question. Number two is what is your biggest challenge in the core business? In the acquired assets, sir, is what I hear you saying is that you have a competitive advantage of assessing the assets and also moving very fast because of the cash flow situations. Your turnaround time is very less, and you get this acquired assets at distressed valuation, and you turn around those assets by modernizing them and integrating to your main business. My question to you is, integrating acquired assets is very difficult. Integrating acquisitions is very difficult. How you do? What is the process you follow in doing that, and what is the challenges you face?
Okay, thanks for your questions. I'll answer your questions as I remember one by one. Your first question was what will be typical feedback of a patient when they come to, I think you nomenclature our organically developed hospitals as core hospitals. Everything, all the hospitals are core to us, very dear and work regardless of how they were acquired or organically developed. For patients, our value proposition is just following. We would like to deliver a very, very high quality patient care for the patients as well as their attendants. And we would like to deliver a very, very high quality clinical outcomes. So all our procedures are geared to deliver these two things. Our doctors, our specialists are all 100% employees, and you'll be surprised to know that we have never, we do not work on a system where doctors have a revenue target or a number of patients target that they have to bring along with it. So doctors also are assessed solely on the basis of performance across two parameters, patient care that they are able to develop and clinical outcomes that they are able to realize. Everything is geared towards that. All our systems are geared towards that. For example, if a patient comes even in the night, what time it will take, regardless of whether it is a Sunday or a Monday or a national holiday, for the patient to get an attention from a specialist, there will be an SOP for that. So everything is geared towards these two things, including what F&B we are able to provide to patients, patient care, clinical outcome. This is what we focus on. I have a feeling like this is why patients throng to Park. I have to mention to you that as of Q3 this financial year, we OPD plus IPD had a patient volume exceeding 6.7 lakh. By the end of this financial year, it will be 9 lakh or thereabout for the full financial year, which is a staggering number. Imagine that 9 lakh patients visited 14 Park hospitals, one of which was only halfway operational in the financial year. So 13 and a half hospitals, 9 lakh patients visiting, about 3,250 beds which were operational during this period. It is quite something. They would do that only if they are satisfied on these two criteria. Maybe they can let go of the fact that their bed was not remote controlled but was manually operated. In any case, medical staff has to operate the bed. But these two things is what matters to them. And ease of convenience. It is, sometimes not adequately appreciated that in our country, bottom and middle of the pyramid market is 90% because we focus on absolute numbers. We are a vast country, so 10% business also is 15 CR, more than the population of Russia. So technically, you have TAM in all these segments: top of the pyramid, which is 15 crore, bottom and middle of the pyramid, which is maybe 125 crore. In Park, what we do is that we do not cherry pick customers which segment they come from. So everyone is welcome, regardless of their socio-economic status. And it is a patient's prerogative also to pay how they want to pay for their medical treatment. They might want to using cash option, card option, or private insurance. Private insurance penetration in the country, I'm told, is still merely 4.5%. Or they might be covered by some of the other government insurance schemes. So it is my duty, responsibility, not to choose patients on the basis of how they would pay for the treatment I would provide them, but to have requisite skills in my system to work around that payment system. So sometimes patients also get drawn because they find that if they are covered by, for example, a central government scheme like ECHS, a certain hospital might, if not directly, indirectly indicate that there are no beds available because they might not have capability to handle that payment because they have carved out nearly 100% of their business from the 10% segment. As I said, that 10% segment also has a significant impact. So combination of all these things, that we would not judge patients on the basis of their payment system. We focus on patient care and clinical outcome, single-minded focus, and everything, infrastructure, attendance, SOPs are designed to deliver these two things for the patient. So I would think that they think well of us. I also have to share with you that if you should do a bit of check, which is easily doable these days, Park does not have any litigation to my mind. There might be a stray case of some petty matter once in a while, but which is unusual. This can happen only if we are consistent in providing these two things, high quality patient care and excellent clinical outcomes.
So sorry to interrupt, sir. Sorry to interrupt. One metrics is actually, patient ratings. Patient ratings. So patient ratings across Park, Medi hospitals is around 3.5 to 4 on a rating of 5, which is little lower on the lower side compared to other hospitals.
Very hard for me to actually reply to that question because I wouldn't know which ratings are these, what was the sample that was undertaken, what might be the motivation behind these ratings. So I would reserve an answer. I would normally expect that, if you visit Park hospitals, you'll be surprised. We have our QR codes displayed in all the areas of Park, which does not require permission. So attendants, patients, or anyone visiting Park can actually just scan the QR code and give a live feedback then and there, which gets logged in the system. You will be surprised to know that as I speak with you on my phone, if I should not check it for 1 hour, I will have roughly 300 images from different hospitals, which are very granular. Granular in the sense that if there is a stain mark in a certain WC, it will get flashed. So this, this is constant traffic on this management group. This is seen by everyone. The feedback system from patients is, to my mind, exceptional. And not a single patient is missed out. Every discharging patient, their attendance's feedback is taken and it is put on this forum. So I would think that patients of Park are very satisfied with what we are able to do, which also translates into a lot of repeat traffic. So one patient. So Parks' business is not based on advertisements, branding. You will rarely find our advertisements, hoardings, billboards anywhere. It is, to be frank with you, simply based on word of mouth. So unless we were not having a strong word of mouth, we would also not be having 9 lakh patient volume across 14 hospitals in a year, which were operational during the time. So I would like to dismiss this number, whichever is the forum, without, not in a denigrative way, but, I do not know what is the genesis, origin, motivation of this survey, but it is definitely totally disconnected with reality.
Sir, what I'm doing is I'm also investor in Park Medi, and what you're doing is very good in the affordable segment. I'm only saying that how we can be better. So if I do a rating across hospitals, we operate a little on lower side across platforms. Our ratings are 3.5 to 4 on a scale of 5 compared to other hospitals, say a Paras Hospital, a Max Hospital, or Artemis Hospital, or a Fortis, or a Medanta. I'm just saying, we are good, but we are still, there's a lot of scope of improvement in that, is what I'm saying.
No. I think your feedback I'm taking constructively. Matter of fact is there is always a scope for improvement. What I'm saying is that the names that you have mentioned, uh, my little difference is in a polite, respectful way that the English proverb that comes to mind is test of the pudding lies in taste. The things on ground are totally different. When we look at Artemis Hospital that we have deep regard for, Artemis, Fortis, Max, Medanta, and Paras are within 3.5 kilometer vicinity of our successful hospital in Park 47. And as I earlier mentioned, ours is the only hospital of these that runs an occupancy of 85%. This traffic validates that we must be doing something that patients find as compelling reason to visit us. Second thing is that a second reality on ground, you mentioned Paras. As far as I know, if you look at the business model, I do not know, how things stack up. Maybe I missed something. They attempted an IPO before us. I believe most of the assets are on a 15 to 20-year lease basis. Maybe they understand about their business, as they obviously do something that I am not able to understand, an asset in Srinagar, Jharkhand, Patna. Maybe they know how to make sense of this. Again, not denigrating, but they also have a PE investor creator who has been literally waiting with bated breath to find an exit. And they could not close IPO in the outlined time because the numbers were not stacking up. Their theme was similar to Parks. They are a smaller player than Park, relatively affordable healthcare and high quality healthcare, but they do not deliver third theme, which was delivered profitably. So there are flaws in the business model. And if you will have flaws in the business model, take it from me. Sooner than later, it will reflect in rest of the other two themes also. If you're not profitable at some point of time, you will stop being high quality. You will stop being relatively affordable also. And market's voice we have to respect. Market didn't lie. So they did do an IPO. So I think my rating is patience. Ranking is investors. As long as this audience is happy, patients are happy, our staff is happy, and we stay above board transparent and consistent in delivering the three things that we deliver, I think that's what matters. I will believe that this is the appropriate way to answer the question. But having said that, your feedback is constructive. I will ask the team to look into what ratings these are, and maybe we will have some more insights.
Thank
Yeah.
you. Thank you. So the
Yeah, we
last
can have a next
question.
question from. Acha, okay. Yeah,
So
Divij.
last question, if you can elaborate on how you're integrating the acquisitions into the core, because that's a very difficult thing to do. What is your process apart from, modernization, getting the new services? What you exactly do, if you can say, elaborate on that, sir?
Yes, very well said. Acquisition integration is it looks very glamorous on the surface, M&As, acquisitions, etc. But integrating them into the mainstream business and in a value additive way is easier said than done. Some of the companies which are renowned names, including Tata's, maybe HDFC Bank before that, IDBI Bank, culture mismatches, process mismatches. It's not easy. It is very, very difficult. So when we look at acquisitions, uh, it is not like we have done 10 times over. It is not like we got everything right in the very first attempt. It has been an iterative exercise. When we do acquisitions at a basic level, we know what is to be done, what is not to be done, what is to be avoided. There is no only one way to figure this out through being in the grind. You figure it out over a period of time after being in transactions. So when we look at acquisitions, we are clear-minded that acquisition entails two steps. One step is very important: identifying the asset itself, which will be value accretive. Something that is great does not mean it will be value accretive to me. So identifying this asset is structuring that acquisition into an optimal transaction, executing the transaction at fast pace. So that is part number one. Second part, which is the hardest part, is integrating this in the mainstream business and then extracting significant performance improvement from this asset post acquisition in a compressed time frame. Your question pertains to part two. So what we do is, when we identify an asset and we decide that this is value accretive to us, we enter into contract, as a part of which uh, typical period mandated to close the transaction is 3 months, which includes everything: due diligence, payment of monies, etc., etc. But we provision a clause in the agreement that Park should be allowed to pursue HR practices, system improvement, and infrastructure upgradation in the asset from the date of inking this agreement. So we get 90 days headroom to start working on this from day one. So what do we do is deploy our cross-functional teams from different units. We also have a very vibrant team of trainers who are deployed to the new acquired assets, just to bring them as close to running of our hospitals in as less a time frame as possible. And post that 90-day period clicking, when we complete the full payment, we do very, very close, very granular hand holding for 2 to 3 quarters time. So usually, in our experience, this effort, significantly advances our agenda of making this hospital as closely as I aligned to our mainstream business as could be possible within this time frame. And one striking thing in Park is, and some of you, as you should find time, I would encourage you to take out time from your busy schedules to visit our hospitals. When you visit our hospitals, you find the driving spirit of hospitals, the culture, the vibe in the hospital to be consistent across hospitals. I will not name hospitals, but sometimes you find hospitals where you say, oh, Chennai hospital feels different, but Delhi hospital feels different. In Park, you find that there is a common vibe, common culture that permeates all the hospitals. And we believe that this has happened because we have been able to successfully integrate these assets. Also, it can be argued that when we acquire these assets, these are like assets which have unstated badge on top of them, saying I'm more like a Park hospital asset than any other hospital chain's asset. In terms of location, markets they are located in, teams that we onboard, it becomes consistent with what we are running in the mainstream. Other than this hospital, these are some of the reasons. Acquisitions are hard. But I would still not say that we got acquisitions right solely on the stroke of luck. Clearly, constantly fine-tuning to-do issues and our learnings from not-to-do issues has brought us
Thank you, sir, for your detailed answer. All the best, sir.
here. Thank you so much.
Yeah, thank you, sir, for detailed answer. We can go to the next question. Chiranjeev, sir, you can ask your question. I've allowed your mic.
Yeah, thanks for the opportunity. Is my audio clear now?
Yes, yes.
Yes, we can hear you
Okay.
clearly. Yes, thank you.
Yeah, thanks. So my question is regarding this revenue exposure to government schemes. In your core business, this revenue exposure as on date is something like 84%, which is quite concentration, and it is impacting our cash conversion cycle. For the upcoming acquisitions which you have done and you are doing, do you have plans to reduce this exposure?
Aryan, like 34 lakh capex, this is an important question. So, with your permission, I'll take 2-3 minutes time to answer this question
Yeah,
because
yeah,
this
definitely, definitely.
everyone who is on this forum today. Your question again is in two parts. One is composition of government exposure in the revenues, and second is taking this a step forward, trying to understand our receivable cycle. Uh, First part first. You see, uh, again, going back to Parks' business objective, it is providing relatively affordable healthcare, which is very high quality, delivered profitably. Whatever we do, the business model that we have, we would like it to be in very high integrity with our corporate objective. There should not be a disconnect, a dissonance. When we look at the macro situation in the country, uh, 90% population belongs to bottom and middle of the pyramid. Uh, so it is not like I cherry pick them. I just let them seek our hospital services. We have three hospitals. We're going to have three hospitals in Agra by FY28, and these three hospitals with a capacity of 1,060 that my good friend Aryan shared with you early on will be providing access to Paxis services to a population of nearly 1 crore people. So people, covering the vast swaths of population and offering them this value proposition is our objective. It is just coincidental. It is even incidental that these patients who are 90% are covered by some of the other government insurance scheme. This is not something that I have chosen. I just have chosen my business model and I have provided that access to patients from all sections of the society. So if this patient comes and says that, I would like to pay for your services through ESI, I can't be doing a huddle in the next room saying that, I wanted a ICICI Lombard patient. No, I just have to develop that expertise that I can manage that. So you find when you look at Parks' patient mix, partial, good thing is a very healthy thing, which is very especially healthy for longevity of a business, that our patient mix closely mirrors the reality of our country. In our country, the mix of top of the pyramid and bottom middle is 10-90. In our business, this patient mix is 20-80. Now, at the time of IPO, it was 1684. It is 2080 now. We believe that very soon, in 6 months' time, this will be about 25-75, which is still very healthy because just imagine that from the 10% segment in the country, my patients, 25% come from there, 75% come from 90% of the segment at macro level. Imagine if I was to tell you that 90% of my patients come from what is at macro level 10% segment, it might in terms of numbers have significant TAM still. But I think for if you extrapolate business for next 100 years, we would like to run our business for next 100 years, you find that in terms of longevity, it is good thing if your business model is in sync with what is the reality of at macro level in the country. That is one. Second thing is a patient mix is like that. Now, when you translate patient mix to revenue mix, which is how these patients pay for their medical care, then it so turns out that in the revenue, you find that 20% patients have paid through government insurance schemes, and sorry, 80%, 20% through cash and TP. To us, both payment mechanisms have relative advantages and disadvantages. Private insurance, for example, is constrained in terms of how much coverage can it be. 15 lakh is typical cover for 4 people family. ECHS government, central government insurance scheme will provide unlimited access, could be few crores also, subject to uh, uh, mid-stage approvals whenever a procedure so requires, and would cover more than 4 people, not just immediate spouse and 2 kids, but a father, a dependent, few other dependents. So that is one thing. Second thing is one could argue that working capital cycle for a private insurance company might be 25 days. For government insurance schemes, central government schemes will be 3.5 to 4 months. Fair point. Third thing, one could say that when one takes private insurance or cash TP patients, you find that at the time of making payment, they will typically ask for a discount, which in the industry tends to be 10, 12, 15%. In case of government insurance, there is a analogous disallowance which becomes applicable, which is in case of Park industry lowest at 8%. So both have their advantages and disadvantages. The business's success is not based on how patient will pay. for the services provided. It is solely based on robustness of business model. A case in point, you talked about Artemis. Artemis, to my mind, has country's highest RPOP, but their EBITDA profit is only slightly more than half of par. This is not to say that they are bad hospital. They are fantastic. We have great regard for Artemis, but this is just to say that we run our business model maybe in a more robust way. If you look at Paras, someone talked about Paras when they attempted an IPO but could not do it. You will be surprised that cash TPA composition in their revenue was 70%, but their PAT was negative. If you look at Faridabad's most successful hospital, it is normally jokingly called as most successful and worst managed hospital. I would just keep it at a light-hearted level, owned by Dr. Narendra Pandey. It does about 35 CR of revenue a month, nearly 72% of which is cash TPA. But their profit is once again negative. They would get IndusInd Bank loan at 13.5%. Park would get SBI or HDFC loan at 8% linked to repo. So what I'm saying is that cash TPA composition or even RPOB, high RPOB for that matter, are not definitive indicators. These are not causative things, maybe correlation, but not causative relationships. So that's what. So in case of Park, revenue mix looks like this. Talking about working capital, since 93% of our patients translated to payment mechanism, 93% of these government insurance companies tend to be central government, proxy for government of India. So these payments at one level are bereft of any default risk. There has not been 1 rupee default or amount written off ever in the entire history of Park. Second thing is that these payments are faceless. We don't even know who processes the bills. So we get a login. We track intermittent stages of approval as the file passes through the chain leading to payment online. Very time bound. Intermittent stages are also time bound, and we realize the payment in 4 months' time as of now. This working capital cycle for government insurance schemes is 4 months. We believe that in another 6-7 months' time, because of increased involvement of AI, automation, and process improvement and training, this will come down to 3.5 months. 3.5 months now, again, pausing on this number for a moment, it might optically evoke a question that does this constrain your accounting numbers translation to cash flows? Valid question. The fact is, in our entire history of Park, we have done a capex of 1200 CR. So on one hand, we were capex efficient. If someone had paid 1.25 CR per bed of capex, that means we have saved 5,000 crore over a base of 5,000 operational beds approximately already without adding interest on top of that. So we have been capital efficient. But the bigger point I'm trying to make is that of this capex, 70% was funded by accruals, which is why our loan before IPO was 425 CR. Point number two, to give you an example, in FY25, what was FY25 P&L top line, which was 1393 CR. During the 12-month FY25 period, we collected 93% of this, which passed through the cash flow statement. This 93% that we collected in FY25 was more than the number of FY24, meaning thereby that we completed collection of all the P&L top line numbers of FY24 as well as some portion of FY25. Point number three, we are the only large hospital chain of our size in the country that keeps no operational creditors on the books. So whatever operational creditors we have in a month, we pay them in full in the next month, in the first fortnight. We have done this unfailingly for last 6 years. In the process, we have made nearly 6,000 crore of payments without missing a month in between. Only way I could do this would be if I was generating a strong cash flows. We also have a strong reserves. Our gross loan outstanding is 8 CR as I speak with you. Our balance sheet can withstand without any deterioration in the credit profile a loan of up to 1,700 CR. We are, this is strong financially in terms of liquidity at our disposal, balance sheet strength, cash flow strength, P&L strength, simply because we generate a strong cash flows. Put simply, our generation of cash flows suffices every time, every month, every year to help us achieve 3 objectives. One, our cash flow generation amply, abundantly covers all our operational costs. 2, over and above this, we collect some more which we added to our reserves every month. So the FD reserves have grown month after month. And third, after doing this second piece also, we still save some more, which we typically accumulate for 4, 5, 6 months time and use as accruals to pursue our next acquisition. So in short, receivables, we are comfortable in a band of 3.5, 4 months time. Our debtor aging is very benevolent. 85% of our debtors are up to 4 months, 95% are up to 6 months, which is, and there has been never a 1 rupee write-off. So all in all, once again, if I choose to be slightly lightheaded, I would even say that this working capital thing, which we have provisioned historically, today I only have to provision this for incremental assets that I'm adding to the portfolio. Maybe this also serves as a business mode today. If someone has to endeavor to compete with the Park to this scale in this segment today, they will have to provision this working capital on day one, which will be considering scales of Park about 800 CR to begin with upfront. This is an entry barrier also. All in all, it does not affect our performance at all, and we are comfortable at this time.
Perfect. Very
Great.
detailed
Thank you.
answer.
Thank you very much. Very well explained. Uh, so my next question is
Yeah,
actually a follow-up of
before that,
Devashish.
Chiranjeev sir, can I, let Mr. Neil ask and then we can go to your question.
Cool. Thank you, Arya.
Yeah, thanks,
Yeah,
Aryan.
yeah.
Thank you, sir, for doing this. I have one simple question initially. That by FY 28, you have guided to have 5,260 beds, 5,260 beds, right? So, what do you think?
5465.
Yeah,
Yes.
yeah. What do you think would be the split between acquisition and greenfield? Do you have any plans ready for that?
Uh, Early on, as a start to this presentation, Aryan so succinctly summarized our expansion plan over next 2 years' time. This entails a good mix of greenfield and acquired assets. What we are launching in Kanpur, Panchkula, that is the next launch in the next 3 weeks' time, is greenfield asset up to 350 beds. Kanpur 300 beds is you can call it downfield. It is for the first time asset light. Following that, 200 bed in August this calendar year is a acquired asset under the provisions of IBC. After this, our Gorakhpur asset is also asset light O&M model set for commissioning in April 2027. Following that, we will have organic development, Ambala extension of 200 beds in October 2027. Mohali extension of 150 beds is also organic development set for commissioning in September 2027. And Rohtak 250 bed capacity, which is briskly under construction as we speak, is also going to be organic
Perfect.
development. So this is that.
So as per our target of FY 28, where do you think our RPOB will stabilize? So right now it's around 27,000. So what's your target? Anything in mind?
Our RPOB has grown a 9-month period in this financial year at about 7.5% compared to 9-month period of previous year. Going forward, we recommend our RPOB will grow in the band 10 to 12.5% year after year. We have to be mindful that while RPOB grows, it has to stay in high integrity with our business objective. If it suddenly becomes 50, our business objective will not be in alignment. It will not resonate with what we are trying to do, and something will, give in due course.
Sorry, sir.
So
Can you repeat? RPOB will increase by 10 to 50. I couldn't hear you.
10 to 12.5%. Yes,
10 to
annual.
12. And this will be on account of a change in case mix or payer mix.
It will be, sorry, say again.
Will it be because we'll be taking more difficult cases? So it'll be the increase in RPOB will be due to case mix, or we are moving more towards cash or TPA system?
It will be, I think, combination of things. Of course, there will be base level inflation increase in the prices, but larger part on account of product services mix. For example, the 150 new beds we are proposing to commission in Mohali will be totally 100% dedicated because market so demands for very, very advanced super speciality. Not just super speciality, very, very advanced.
Correct.
No? When I say advanced super speciality, advanced tag attached to super specialty, which itself is supposed to be advanced, means it is going to
Correct.
be very cutting edge medical stuff coming into play.
Okay. Okay. And right now our one-third revenue is coming from internal medicine. So can you throw some light on internal medicine is exactly what?
Internal medicine typically covers everything, whether it is lifestyle diseases, fever, etc., infections. Traditionally, internal medicine was everything. Hospitals sometimes would do the following: that they will take certain patients in OPD,
Mm,
charge OPD fee, and then put them in a cardiac sciences, neurosciences, gastro department, etc. Would categorize it like that.
mm.
All the patients, typically, most patients do begin with the internal medicine. This is how our internal medicine composition looked like 47% at the point of time. Right now, it is 26%. Will decline further with contribution of major specialties hovering in the range of about 7% to 12% right now.
So do we have some case in mind where we are strategizing or focusing more? Are we focusing more on oncology or on neuro? Because I see the second highest revenue is coming from neuro currently. So are we targeting some case specifically?
We do what market requires. Important thing is all our hospitals are equipped to provide. There are about 36 super specialities. All our
Correct.
hospitals are provided equipped to provide all 9 yards super specialty services. Having said that, your question is entirely proper because it so happens that certain markets have a certain dynamics. Sometimes it so happens that certain disease or ailment has a higher prevalence in a certain market, and we have to orient ourselves accordingly. For example, Ambala region, we sensed the oncology requirement in that market was increasing dramatically. It has a lot of ex-services population. I will not comment on lifestyle situations whether people like to imbibe alcohol or they are hookah smokers or they come from Punjab. But we reckon that we needed to especially increase our capacity focus on oncology there. So this 200 bed capacity augmentation that will be commissioning in Ambala in October
Hmm.
2027 is meant to be a cancer institute. So we just try to be in resonance with what the requirement of the market is, but at the same time we equip all the hospitals to provide all super specialty services.
Perfect. And are we taking any specific steps to reduce our average length of stay?
I'll just answer this question. Just allow me 1 minute recess, please. Just join.
Yeah, sure.
Yeah, definitely.
Thanks for your patience. Can I come to answering the question on a loss?
Yes, sir. Yeah.
Yes,
So
sir,
I was saying,
definitely.
do we have any proper steps in place to reduce our average length of stay?
Well, yes, our loss, to put it in perspective, used to be in the range of nearly little less than 7 at a point of time. It has come down over a period of time to 6.3 right now. We believe
And
because of increasing adoption of uh, new advanced machinery. We have three Da Vinci latest generation robots. I think in Gurgaon at least the only large hospital chain to have three robots and the state of the art equipment. Maybe this can come down to 6, 5.5 going forward. But while this answers your question precisely, I would like to just add to that. Aryan, with your permission, can I just add some more to that? It
Yeah,
will be
yeah,
useful.
yeah, definitely, definitely. Yeah.
See, well, again, early on, I mentioned that we try to be mindful of that we don't want to create a distortion in our choice of customers when it concerns Indian market. We choose to acknowledge it rather than cherry pick patients. And the real situation in the country is, which is I think all of us can relate to because we live in our families. Some of us live in joint families. People who are young. Saurabh is younger than me. Young people go to hospitals less. It is plain biology that as you age, tissues age, bones age, you have requirement of going to hospital more. So broadly speaking, if there was some documented data available, although people do still make amorphous estimations, if you did a slicing of how many beds in the country for accounted by people by age profile, you will find that this number will land you in a situation where you will discover that nearly 60% of beds are accounted for by people who are 60 years or over. So here is the thing. In Park, because we do not cherry pick our patients, nearly 60% patients tend to be in this age profile, who we call as geriatric, who are 60 years and over. So these patients now are characterized by two features. One is they typically will have comorbidities. So patient who comes for diabetes related ailment could have a situation related to eyes, heart, kidneys, pancreas. Uh, and second thing is typically, even if it's a basic situation like diarrhea, maybe you and I can recover in no time, but these guys will require a longer time. Sometimes they might discover some additional ailment along the way. So if you have to treat them well, we also work under a little strict inspected environment of insurance companies. So especially as the central government insurance schemes are very, very thorough in their uh, uh, checks and balances. We cannot be shutting the patients out after doing the procedure because we believe that procedure is where the real money lies. So let's let them recover at home. We have to cure them and have a reasonable surety that rest of the recovery can be at home. So business models are different. The business model that is driven solely by ARPOB, for example, will intuitively want to focus on the procedure because turning out procedure patients fast increases ARPOB. For me, the whole thing is I would like to treat this patient because I work bottom and middle of the pyramid. That is my main audience, although we have 20% composition of patients from the top segment. So we would like to treat them. So therefore, ALOS tends to be, there is no good or bad ALOS. The real ALOS is that it should be in sync with your business model. That is the most important thing. As an interesting aside though, I would like to say that different people reach good businesses deliver a strong profitability, which we do. So good businesses will have different way of reaching there based on what the business model they follow. So as an interesting trivia, you will find that, if you multiply ALOS and ARPOB, it translates into a metric called ARPP, average revenue per patient. So if you do ARPP working at 6.3 and 28,000 of ARPOB for me, maybe we are at ARPP of 1.8 lakh. If you will do ARPP calculation for Medanta or Max, maybe it will be nearly the same. They will have 2 lakh maybe, but 93% share. So eventually landing at the same ARPP. So this is how everything works.
Makes sense. Makes sense. Just one last question. I'll quickly ask this to you. Certainly, at what cluster density do you see material cost synergies?
Uh, it just so happens, I think right way will be that let me answer your question by citing two instances which will clearly answer your question. One is look at how we have grown in cluster formation uh, from Delhi towards belt covering Haryana, Punjab, Tri-City. We have a hospital in West Delhi. We will be commissioning a hospital in North Delhi now, which we acquired under provisions of IBC. Then we have along that road in 45 minutes time a hospital in Sonipat, another 45 minutes on the highway in Panipat, another 45 minutes near the highway in Karnal, another 45 minutes on the highway in Ambala. Then on the highway, slightly this side is Mohali, this side is Patiala, and along that stretch, some distance away is Patiala, and now we have Panchkula in the Tri-City. So what happens is we don't look at the specific hospitals as micro market. It is an important consideration. Though what we look at is, for example, we have oncology, which has three streams: surgical oncology, medical oncology, and radiation. So two things will be available in every hospital. Radiation bunker cost is typically estimated to be 35 CR thereabout. So that we can have in one place rather than at every 45-minute location, because that will not translate into ROI or even substantive benefits for the patients. Likewise, we have a PAT lab, fantastic setup in Palam Vihar. Since we have it in Palam Vihar, Gurgaon, maybe we don't need in a hospital that is 45 minutes away from there. So these advantages happen. Plus, we have advantages, of course, of pooling in our requirements of raw material consumables, which anyone can do. But this is how cluster formation goes. That is one way. Second thing is, I said I was going to share with you two situations to highlight this point. Second is, let's look at the UP itself. UP 27 crore population, Aryan mentioned, which makes it maybe the fifth most populous, if it was a country in the whole world. This is slightly less than the population of US. We had long wanted to be in the UP. In fact, whichever place we go to, we aspire to endeavor to have a critical size. Haryana, we are the largest. Punjab, we are critical size. Tri-City after Panchkula, we will be largest going past Fortis. Delhi, we will have two. Haryana, Rajasthan, we have two. So we wanted to be in UP, and to think that in 2 years' time, 24 months' time, from zero, we will have 1,060 bed capacity in UP. One, and to think, since you asked a question about micro market size, we are starting with, now just look at the UP strategy. If you visualize UP state along the X coordinate, you find that Agra is to the eastern side, Kanpur is to the middle, Gorakhpur is to the west. So we would have covered in 24 months' time the span of the state technically, fairly exhaustively, and then we can use these locations as pivots to develop clusters around these regions. Of course, what is helpful is that UP boasts of one of the best highway infrastructures, large TAM population, pivots in three important locations covering the span of the state. Excellent road infrastructure will enable us to form few clusters there. Talking about micro market size, Agra has a micro market population, for example, of 18.5 lakh. Gorakhpur has 11.5. Kanpur has about 20 lakh. Adding this is about 50 lakh. Typically, in our hospital way of looking at micro markets, we double the number when we try to arrive at area of influence number. So this becomes area of influence across three locations becomes 1 crore. So just imagine in a high potential state where our services are absolutely definitely required. We will have three locations covering the entire span, 1,060 bed capacity in a capital efficient way, providing access to our services to potential 1 crore population. So I think this is just let it sink in. This is staggering. This is how expansion strategy should look like. I think we are bit by bit getting UP so totally all right.
Perfect. Thank you. Thanks a lot for answering all my questions.
Thank you so much, sir, for this valuable insights. I guess we are like slightly running out of schedule. We can wrap it up before the last question, sir. The last question is from Manish, sir. He's asking that what percentage of revenues from international patients are we expecting some drop in the revenue in the Q3 due to the ongoing disruptions due to US-Iran war, flight disruptions of US-Iran war?
Very good question, very topical. Technically, one could argue that what is Park's business proposition or medical services proposition for patients is what at a larger level is our country's proposition for international patients, that they can come here, get cost efficient, relatively affordable, high quality medical services. So I was in Mumbai last month, and one of the persons very intelligent from your ecosystem shared with us a very stark data. He said that nearly 50% of international patients who come to India basically come to Delhi, Gurgaon. So I was surprised at that number, which updated my own knowledge about this number. So we do get international patients from African countries, Far East, Southeast Asian countries, Cambodia, Vietnam, etc., etc., and the Indian subcontinent, of course, also Middle East. Our This will grow. In the recent budget, one can argue in terms of substantive things what will it translate to, but when government said that they require private sector participation in creating international tourism hubs, I think the intent is clear that government wants this to grow. So they will be enabling an environment supporting this situation. Our international patient-driven revenue was about 70-75 CR. As international patients grow coming into the country, and if our Mumbai friend got it right that 50% of them visit NCR region, we will definitely benefit from this. The recent situation, very hard to tell, is difficult to predict, but we believe that all said and done, the hospital sector is still the one that is most shielded from these developments. People will have ailments, people will grow, body will become frail over a period of time. Some will contract diseases, and there will be requirement of medical care, both domestic and international. Travel constraints, which are transient, temporary, notwithstanding. What is clear is that this will grow going forward, and any government wants to support this. And because so many patients come to Delhi NCR belt, we will benefit from this. So while 70-80 CR is not a needle mover for us right now, this will increase going forward.
Wonderful, wonderful answer. I think we can wrap it up here. On behalf of everyone, on behalf of BVCA team, thank you so much for this detailed answer, sir. Thank you so much for coming, giving us your valuable time to us. Thank you so much for everyone, for coming at today's session, asking those questions. So yeah,
Thank
we
you,
can wrap it up here.
thank you everyone. Thank you for your patience and my personal accolades, commendations to the quality of questions that came up enabled me to answer those questions on behalf of Park. I think this was a high quality session. Aryan, thank you so much for coordinating this.